People look at things that are moving, and it's the excitement around it, and it tends to drive everything around the markets. And even cocoa, people start to look at everything because of what's going on so aggressively in one area. Does it move to commodities? And if commodities are moving, does it impact equities? Once these headlines stop creating an impact, or there's not any more hype to create a movement in prices, you're starting to lose interest. Hello and welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, today joined with James, Martha and Vincent. So we've grinded to a halt in outright Brent Futures, and generally speaking, all the excitement has been taken out of the market. You get a distinct sense of fatigue from market participants after a few wild rides in key contracts and sleep-depriving global events. So without further ado, let's dive in and let's see if we can eke out the key drivers of the oil markets and what will be useful looking ahead. So Martha, do you want to start us off?
So looking at Brent Futures in the past week, there are a few headline bits of information to start with. So right now we're about $87.50 a barrel, with prices gapping $1 lower on Monday's open due to the talk of the ceasefire negotiations in Cairo. So the proposal includes a 40-day truce, releasing hostages, and allowing families back into northern Gaza who've been displaced. So this could be the end to the geopolitical risk premium that we've seen added onto the Brent Futures as well as the rest of the products recently. Obviously, this hasn't happened yet. So there's still time for this to be called off or this to be rearranged, but it seems like the market really does believe it by that significant drop. It was the biggest drop in almost 2 weeks. So pretty significant. We went from it was almost trading at 90, and then there was just that heavy sell-off. Also, last night, there was an OFAC announcement made under the cover of darkness about authorizing transactions related to energy from Russia. So this is not very clear how this is going to play out. It's quite interesting because, it was just in late February when the second largest packet of sanctions was put against Russia, and now they're essentially lifting them, taking them off Turkish ships and things like that. So this is a pretty big U-turn, and all signs point to the election, really.
Yeah, let's dive into a bit of this because this is quite interesting. So OFAC, foreign agency, whatever it stands for.
Office of Foreign Agency.
Office of Foreign Assets Control.
Okay, so we've got a US, there's a US government agency, and they are behind closed doors basically releasing more Russian oil. Really, really interesting to me because that's, basically, as you say, like the election's coming up. And I think it's been made quite clear probably in the administration that, with the whole hiccup with we're going to be buying back all our SPR and with oil like on the seeming rise until kind of recently, that's super interesting. Like they're having to clutch at straws to try and release what oil they can. Like the similar thing, I think it was a couple of years ago, was the Venezuelan oil, right? They released a bit of sanctions there and got Exxon involved to kind of get more of that excess. And I guess that's what the price cap was all about as well, like encouraging the oil to flow, just trying to diminish the revenue. But it just comes back to the same thing, like trying to sanction. Jorge was talking about it quite clearly. It doesn't work. It hasn't worked. It's only hurting themselves. So I guess they're kind of unraveling this, but they're just at that risk of them making themselves look weak as well as having messed up. So it's more of a political thing.
Yeah.
But what else can we say about this? We're expecting...
I guess all eyes are on India, really, because they'll be getting the oil. China haven't really paid attention either way to the sanctions, but they may still be receiving more because there'll be more ships around. But it'll be Indian refineries, I think, that will be taking the brunt of this.
I think China did have their fair share of Russia in 2022, but they've moved more or back towards Iranian, which was always the case. I think Iranian oil must suit them quite a bit better on the refinery side, maybe the discounts, but I hear, you wouldn't know that there's sanctions. The Iranians are very tight with their dealing of oil. Like they get a good price. It's not like they're getting huge discounts. So it must just be about the specification of oil, maybe the route, the way they prefer the Iranian. But Indian, we know, favors Russian type oil. Urals being the main one, being a heavy grade. The Indians have the biggest refinery in the world, and Reliance is Jamnagar. It's they love a heavy crap crude essentially, and they produce a hell of a lot of diesel and send it back to Europe. So I think this is relevant because they had quite a big term deal. I think was what was going on. I don't quote me on this, but it's just that was starting to run out. So suddenly they were stopped buying Russian oil, and all of a sudden, I guess the US are kind of encouraging them to do so again. It's all a bit. It's just a complete mess. But yeah, that's interesting, and I think. But the sell-off itself, you got a few notes on like who could have been responsible for that, right, in terms of participants.
Just looking at there seems like there was a massive liquidation of ETF positions, so exchange traded funds, week on week, huge OI and open interest decline. I think these ETFs are often used to hedge against geopolitical risk, as they're like a basket rather than a specific grade. So they're kind of like.
Well, it's the way investors get access to these futures. They let the funds do the admin essentially, handle it or roll it every month. So you invest in these funds, you get a very good price these days. You got like the best market makers in the world, Jane Street, Flow Traders, these kind of companies that are providing such a tight price that trading an ETF in Brent Futures or WTI Futures is as good as trading the open market. So I think something we'll be doing one day. It's just it is a very good way to access oil contracts. They just need more of them. But so it's definitely something that I guess by definition, if it's that straightforward to access and that useful, it would probably more likely grow than not. So increasingly, it's an important thing to track. So the outflows there, is quite a clear sign if that's what was the big driver of liquidation of longs and maybe even getting short. We can kind of blame the investor side for the kind of halting in the rise in outright Brent futures or outright crude futures. And it would be logical, right? So it's an end to the geopolitical tension as it was, as tense as it was. And I think actually we have to dive straight into the macro side, right? Because investors are obviously very sensitive to macro, and we've had quite an abrupt shift, haven't we, James? That you've been talking about yesterday in your Macro Mondays. But can you give us a summary of what was going on there?
Also, first about gold and silver, because of these geopolitical tensions falling, we've got gold and silver have basically given back a lot of last week's gains. And gold right now is trading at 2,313, just $25 above where stops will get triggered. So you're seeing the tensions being taken out of the price there.
And you call this risk parity as well. No, we've talked about this before. The type of investing, is it fast money investing, people hedging for inflation, hedging for geopolitical risks with gold, using ETFs for oil, or is this part of a risk parity play, to balance your portfolio and they're now deciding it's time to exit? It seems a bit too quick for risk parity if you just
I think this is around geopolitical tensions as well. But what I discussed yesterday on the Macro Monday is we've seen a huge surge in retail investing in gold in China.
Okay.
I mentioned that the central bank has bought gold for the last 17 months consecutively, but some data came out last week, the Shanghai Futures Exchange, and volume spiked on the 15th of April. The volume was 5 times higher than the daily average for the last year. And what you have now, retail investors in China, typically they have over 70% of their investment in property, but of course that's been falling for well over a year now. So it looks like they're starting to move in. And having lived in Asia for 15 years, retail traders in China particularly are so aggressive in their trading. Again, I spoke on Macro Monday about when they've been trading cotton and iron ore in 2016, the prices doubled in 3 months.
That's interesting. And they tend to track what their government's doing, what the Chinese government's doing. So Chinese central bank's been buying a hell of a lot of gold.
They'll, a bit like you see the retail traders in the US tracking the latest stocks or AI stocks or the MEM stocks or the non-fungible tokens. They're trading off headlines and what's moving, and they'll chase it. What's different, I think, with 2016, it was short-term trading. Now it looks like more of a long-term investment.
Okay. So we had that pullback though on the announcements and the kind of easing of this tension. What is the outlook now from that side? Gold and silver?
For gold's sitting right on just above the stop. If stops get triggered, of course, we'll get a further move down.
Potential cascade because everyone got a bit overhyped, right?
And that's fairly typical when you have a big move higher. We've seen it in cocoa overnight. Cocoa was down, was it 15% yesterday, another 10%, over 10% this morning. Markets, when they go up that aggressively, you get aggressive pullbacks.
It's a bubble, right? It tends to be bubble. I mean, we've had quite a lot of this excitement just suddenly eased. The Nvidia stocks retracement. Gold now, silver, even oil to some degree. I mean, it's not pulled back a huge amount, but it does give me that sense that people have just had, 4 months for the year, and they're just kind of start to de-risk, take it easy, have another look again, or maybe potentially getting burnt and to invest in some of these contracts, and maybe there's a long way to go. But it doesn't feel like volatility is picking up quite as we expected. It's actually, if anything, leveling off, especially in oil.
If anything, it's died down in the last 2 weeks. I think the peak was on that Saturday night when the rockets were coming from, forget which way it was, Iran into Israel. That was the peak tension. By Monday morning, they calmed it down. They wanted to de-escalate while having the last word.
But cocoa is not really anything to do with that. But that's another one I didn't mention just there that you were talking about. These are all big moves that people have had their day. And it's one thing I've seen in market participants. We always look at things as a yearly cycle. And, you get your bonus at the end of the year ultimately. But I guess investors probably look at it slightly differently. But at the same time, people managing investments, they'll judge themselves based on an annual cycle. So when you've got to 4 months into the year and you've had certain moves, you've probably made your money or lost your money. And it's probably quite a key inflection point, I would say, around now. And I think the evidence is showing. So as we get into summer, I guess this is the time where you consolidate and we start to see what the next interesting thing is. But is it fair to say, like a lot of these, the cocoa hype, the gold hype, that it's starting to, the Nvidia hype, it's all a bit done now? Is that too early to say that? But
the big moves seem to have been are being unwound for certain. And these are the recent, how would you say it, the products that get highlighted on social media. And for me, it really started with GameStop. That was the first time social media had really kicked in and people
changed everything.
Herd mentality.
Yeah, but it's also just saying, what do you get up and look at in the morning? And I think people look at things that are moving, and it's the excitement around it, and it tends to drive everything around the markets. Even cocoa, people are starting to look at everything because of what's going on so aggressively in one area. Does it move to commodities? And if commodities are moving, does it impact equities? All that kind of stuff. So I guess what I'm saying is that it's once these headlines stop creating an impact, or there's not any more hype to create a movement in prices, you're starting to lose interest basically, because whatever you read, it's not equating to a move in prices.
Yeah, the fast money's got nothing to chase because there's no headlines.
Right, exactly. And if anything, it's then susceptible on the way back down. So maybe a good time to get short some of these things if you've got that, interest to do so, which is obviously quite risky, especially in bubbles. But at the same time, people make a lot of their money from these bubbles bursting as well. So no, this is really interesting. I think it's speaking to the psychology of oil markets as well. Everything is just so intertwined. I don't know if that's definitely not a new thing, but I think, so did you want to?
Yeah, I was going to say another thing we have this week is we have the Fed coming out on Wednesday, and of course they're not expected to move, but we've had some pretty volatile data. We also have employment data on Friday, which is the key data. But with the Fed, last week GDP came out.
That was so left field, wasn't it? No one was expecting that.
Yeah. In fact, it's not normally seen as a key data, but because it was so off expectations, the market was expecting the first quarter GDP to be up 2.5% annualized. It came in at just 1.6. So the economy is weaker than expected, but then also we had the inflation metric with it, which was much higher than expected. The deflator is up 3.7%. And the absolute worst case scenario for the Fed.
Yeah.
So what does Chairman Powell say tomorrow night? Obviously, nothing's expected. They're not expected to move, but it's all about his rhetoric.
Well, he talked as well, the psychology concept of it's always what the unexpected thing is that creates the moves. But we also have talked about lag data from especially macro, just anything being released. It's lagged, right? It's
the first 3 months of the year.
So if you'd asked us as we were talking, we would have said the US economy is firing. All the indications were there. And I guess reflecting on that was the equity rally. I guess unemployment stats were pretty good.
Yeah, employment's been really strong.
Employment's been really strong.
The PMI data has been really strong. In fact, a couple of months ago, all of a sudden it moved to expansion again for manufacturing sector, service sector.
Everything was pointing to a strong economy. So do you wonder if, I guess it's either it's lagged and it will pick, and the data in Q2 should be a lot better, or just got it wrong and those are the wrong indicators, so something else is stagnating the economy, of which we're pretty sure it's probably treasury related, right? And that's what's so important about these interest rates.
And you say the left field events, now people are suddenly mentioning possible hiking. I don't see it personally, but all of a sudden the dollar's getting stronger. That's causing all sorts of crisis, almost. The yen, we saw intervention yesterday. That's causing a lot of problems, particularly in emerging markets as well, where the dollar's so important.
Okay, so I guess just concluding that, I mean, ultimately we're getting into May, getting into the summer months for the West. I guess it's turned from optimism to probably slight pessimism in the macro markets, at least on the US side. Is that fair to say?
I'd say certainly concern predominantly dollar strength and yields going higher.
So Vincent, when we look back to oil though, we had the stagnating period it's kind of like the inverse. We had an underlying market not really firing of late. Outright prices were starting to move aggressively high, heading towards the 90, and then we had this halt, and then we had a lot of retracement. Last week we were talking about the diesel cracks coming a lot lower, seeming like a bit of a breather. But we're right back in it. The EIA stats out of US, the stock draw is pretty significant. We've got the expiry, I think you want to talk about in Brent today, looking very strong. And, at least from our point of view, everything's pretty strong. So it's almost like it's the lag the other way to the macro. We actually are always looking still pretty strong. But yeah, do you want to expand on that maybe? What's going on?
Sure thing. So the underlying oil does seem to be quite strong. If you actually look at the Brent spreads, the backwardation is indicating a moderately tight market. It seems like the recent drivers of Brent flat price has mainly been only affecting the flat price because the spreads, the strength in that has already been priced in. It's more based on the geopolitical premium, and it seems that there might still be a lot of fickle length still remaining in the crude contract. So if there was any, for example, like some headline or some supply shock, then prices might rally $1 or $2, but then come back off again really quickly because these provide liquidity events for these doubtful longs to exit quickly.
Dead cat bounces, that's the way they're seeing it, so they use it as an exit.
Yeah. For example, 2 weeks ago when Israel launched that attack against Iran, which both sides really downplayed afterwards, oil prices did go up to $90, but then quickly gap back down again. So
very quickly. It was almost instantaneous. It's actually sold off,
right?
Which is pretty crazy. I couldn't agree more. I mean, it certainly looks like if you were trading the Israel situation, then it was quite logical what happened, but I think at least from a professional market consensus, it's, people are bullish because of the underlying market and what it's doing. And yes, that's pulled back a lot. Refinery margins got ahead of themselves. They retraced quite a bit. But generally speaking, we're in a very tight market with OPEC having cut off supply even further. That's ongoing. All the same stuff and all the same indications. So I guess it's like your key point there. If people are reacting to, fickle length exiting, these sell-offs, a $1 gap down, I wouldn't even call a gap down. A $1 move you can just by doing a hedge. If you're a big enough company and you need to go out and hedge forward some production, you'll move the market by $1. I think a real aggressive move is 4 or 5%, and that's when it starts. The only reason you're saying that is because it's been so long since we've had a sell-off, which tells you kind of the opposite. That it's actually pretty. If this is the maximum move after everyone's exiting, that's another bullish sign. I think from a positioning sense to be whatever we are, 87 right now. Despite all that's gone on, all this retracement, refinery margins, all the de-escalation, all the geopolitical tension, all the macro weakness, surprise last week, I think we're in quite a good position to rally again. But Martha, why don't we talk about the refinery margins, given that was quite a hot topic last week, with diesel being a lot weaker?
Yeah, of course. So with the crude strength, that's of course played against the strength of the refinery margins. But then we've also seen some product strength in the week as well, with gasoline being the strongest. We've seen strength across all of the products. Gas oil has seen a little strength in the outright price due to the crude strength. But in the cracks, these have yet to see any support. We're still seeing the cracks below $20 in the front, and the spreads are in contango. The geopolitical premium's worst, as we mentioned earlier. We might be seeing a whole bunch of diesel come out of India, and the freight rates are probably not going to. They're probably going to continue, being fairly soft because there's little geopolitical risk premium there in the freights. So, I mean, nothing really looks that positive here. Also, the stocks, the US diesel stocks are the highest since early April. So it just continues to be a pretty grim picture. I know it's harvest season soon, which should support some heating oil demand in the US and China. But I mean, people point to it a lot, but we yet to see anything from that.
I think it's one of those things, like if you're seeing with the positioning, there's a lot of people who were long two long distillates, I would say. I think the market talk is generally people were long and got quite burnt on this sell-off. And I think the signs are probably overcorrected to the downside because we had such long positioning, and now it's being quite aggressive, the positioning change in diesel, right?
Yeah, so the last week, the week to April the 19th, for the CFTC data, the money managed by money positions, the shorts increased by nearly 40% week on week, and the long managed by money positions declined by around 23%.
Yeah, so that's a huge shift
to
short. And I think if anything, that's, stops triggered, that's aggressive move. I mean, spreads being contango coming towards summer, I don't think the oil market is in that state, unless of course the demand is getting destroyed because of the macro situation. But I guess that's yet to be discussed. But we have had some decent demand statistics from Spain and Portugal. That was in notes here. But let's see. I mean, ultimately, I still think that the market is gearing up towards being very bullish for summer. Gasoline Q3 position long, that's the key one. But generally speaking, crude, gasoline, diesel, people have been positioned long in summer for the last 4 years or 3 years, and I think it's still the expectation again. So the only thing I would say is we talked at the beginning of the year about refinery outages, and that was a key theme. We had cold weather taking production off, but actually refinery fires and refineries just generally getting impacted out the US, but globally. I think we talked, and again it was market consensus, that a lot of the expectation of bullish product market, at least, is on the basis that we have more refinery fires, the summer gets worse, global warming kicks in even more aggressively, that kind of stuff. That being the narrative. I would say it's worth pointing out that we had an issue with Valero's one, I think, yesterday, but it's not. I think the further we get on, the more it seems like it's actually not potentially the same issues we had last year. And I think the market should start to think about how, if these things don't happen and we don't get hurricanes and all that everything is on the basis of outages, essentially, including hurricanes. It's meant to be like the most disruptive year for, is it El Nino?
So there was the El Nino event last year, but I think that lasts until the very beginning of this summer. So I think the beginning of this summer in the places which are lucky enough to get heat is going to be worse, but I don't believe that's going to continue for the whole of the summer.
So if that doesn't happen, then you've got a lot for the market to contend with, because it's so long, and you could get a very similar situation to what's happening with diesel happen in gasoline. But that aside, again, we have to look at the overall market being in this position of a deficit as kind of forced there by OPEC. So still plenty to be interested in, and I would probably generally summarize it as people may have been burnt, but if you look at crude, people are still buying. It's still strong in crude markets. I think if anything, people are gearing up for a retracement, and it could it's just kind of a buy the dip scenario. Okay, so those are the core ones, gasoline, diesel, of course. But what about the fringes of the markets? For example, I know that 0.5% fuel oil, bunker demand, there's things happening, or naphtha and propane we talked about quite a lot this year. Anything else happening outside of diesel and gasoline, Vincent?
Yeah, sure thing. So in fuel oil, high sulfur fuel oil has seen really strong demand recently, as you mentioned. So you had like bunker demand from scrubber installed vessels remaining stable, as well as summer power generation demand from South Asia countries. So you might have seen a lot of headlines recently talking about the heat waves being experienced in Southeast Asia, and of course high sulfur fuel oil.
Thailand was very hot, wasn't it?
Especially, yeah. So part of that has led to we think that that's led to more demand for electricity generation for the air conditioning and all of that, and that's in addition to the seasonal demands coming out of the Middle East as well. So that's really increasing the backwardation, and especially in V80 as well as the East-West. But naphtha was also seeing an interesting trend over the month of April, because at the start of the month it really was a refining story. A lot of refiners coming out of maintenance looking to hedge the cracks, which fell down from single digits -9 down to -13, -14. So it was a $4 to $5 drop in just a day. And going into the end of April,
that's a gap down.
That's a gap down.
Yeah.
But going into the end of April, prices have recovered. You have structure recovering. Same with the cracks, back up above -$10 per barrel again. That has actually come from a lot of strength has come from the east, MOPJ buying from Chinese players, Korean tenders rising as they increase import cargo requirements. At the same time, it's a really interesting one, because the ADNOC's reverse refinery project in the Middle East. They have created the temporary supply tightness in the naphtha market because recently they imported their first cargo of Iraq's Basra heavy crude, and because of their flexibility project, now the refinery is actually exporting more of its flagship Murban crude, which is lighter in content, and therefore because less naphtha is being produced from the refinery, that's leading to a bit of supply tightness temporarily.
It's becoming more and more of a theme, like these major producing countries with their refineries switching out their crudes and exporting their own, because Saudi been doing that, and now ADNOC with Basra is saying in Iraq. So that's that is interesting, and it disrupts the flows quite a bit. So that's a fair point. Yeah. Okay. So all right, moving to Googling oil then. Or Martha, do you want to take that?
Yeah, sure. I mean, the main story of the week is the response of the markets to the Israel-Hamas potential ceasefire talks. The US, the Secretary of State, Antony Blinken, has said that the US are going to push for both sides to reach a truce. So I guess that kind of further corroborates this hopeful ceasefire.
Yeah.
I mean, it's just everything we've been saying. And
but again, if we're getting tired of talking, people are probably tired of listening about it. People are tired of reacting to it in markets, and that's kind of the theme here, isn't it?
Yeah. And another piece of news that is happening is that Total Energies are seriously looking at moving listing from Paris to New York. Their US investors are apparently more positive about the company and supportive of its fossil fuel strategy. I think this also may be a bit of a forerunner to any kind of election results later this year, because I think they might definitely get some better feedback or better place to be, seeing investors if Trump gets in.
Yeah, this is an interesting one. It has been making, generally there's a theme of people moving or London companies or European companies moving their listings to US. And I think it's just quite hard to ignore that there's, less tight rules on governance. There's easier to raise a lot more money. You get higher valuations. It's pretty, it's hard to argue with. And I think it was really interesting hearing the ex-Shell CEO talk in the FT Commodities Summit, because he was talking about, I put in a strategy of more renewables focused, essentially because the people asked me to, the people being, the wider community in the UK and Europe. And essentially he's saying I didn't get rewarded for that. There's no rise in stock price. There's, it's difficult. You're still getting all the crap, all the flack, and yet you're trying to do, quotation marks, the right thing. But that's, I don't have a huge amount of sympathy for that, because that's just, jumping onto the trend. You gotta think, Bernalini did the same thing with BP, right? It was ballsy. He tried to shift the strategy. It didn't work, didn't get the shareholder returns. And there's no reward for doing it. So you've got to look at it and think, if you're a CEO, or you're responsible for a company's performance, if you're not getting rewarded for making certain societal based moves, you're going to basically threaten the move out of there if it's not going to. But you can't really threaten people to buy your stock. It's just, they're just not going to. But in the US, if you list there, people are going to get very excited about your potentially. There's a lot of investor-based retail traders. There's, it seems silly, but it's just the way I guess you have to think as a public company. You want as much buying flow as possible. So where do you get your buying flow from? That's why people or CEOs are obsessed with getting their companies into benchmarks, because once you're in a benchmark being, a collective group of companies in this example that reflects, say, oil or whatever. So that ETFs then group you or put you as part of their basket of what they're buying as a way to get exposure to oil companies in this example, and you get more buying flow from there. So if you want that buying flow, the US has got a hell of a lot of it. It's got a huge amount of ETFs, and of course, if you can be big enough, you can work your way into big benchmarks into US. You're going to get, they're the biggest benchmark stock indices traded in the world, and if you can be a part of that, you're going to get a hell of a lot of buying influence. So your average, P multiple or your valuation is just naturally going to be higher. And how can you resist that? So, what do people really expect? But again, we don't want to get political, but it's just getting into that cycle. But it's a trend that's continuing and probably will maintain. It just seems a bit odd that, US have definitely got enough oil companies, but at the same time, does an investor really think of it like that? They want to buy good companies, full stop. So I don't see why they shouldn't get interest, and Shell as well, same story. Okay. Just before we do a trade idea, what should we say is the one to watch? It's probably a macro thing, right, James?
The one to watch, probably data-wise, actually. We have the Fed on Wednesday, and then we have the non-farm payrolls on Friday, their employment or unemployment data.
So if that's, because that has been the strong driver of the reason why we were bullish, or people have been bullish US, if that comes in any weaker, that could be add to the bearish momentum quite a bit, right?
And the average is typically about 250,000 jobs created each month. This month is predicted, I looked at the Economist estimates this morning, it's 240,000 jobs created.
So already lower expectations.
But something I highlighted again on the yesterday's podcast, in the last year, the full-time jobs in the US has actually fallen by 1.3 million. So what's being created is part-time jobs, and there's record numbers of people being forced to take second and third jobs. We also have small business hiring intentions are falling very rapidly, and small business account for 60% of employment in the US. So the signs are, and they've been there for a few months, so that we should get some weaker data coming out, but part-time employment has kept it up. But it's when we get weaker data, then all of a sudden you'll see bonds rally, yields come down, the market pricing cuts from the Fed, and you'll see a dramatic
cycle again.
Yeah, dramatic change in.
Okay, yeah, that's definitely the ones to watch then, I think. And if you're bullish oil, like I think we can say we are, we're expecting a continuing rally in flat price and spreads. This is what will put a key, halt on advancing, as we've already seen. But once you have outflows and bearish positioning, that's only a one-time thing. You can't just, unless the market gets a lot bigger and you get more participants entering who can sell. Once they've sold, they've sold. So there's, at the same time, if they've made their move and you get more bearish data, then it's probably only just an extension of what we've already seen, and it's not been a huge reaction. So even then, it's still not massively skewed. But it's still definitely a very interesting one to watch. I would add, you talked about naphtha having a strong rise, Vincent. That's a pretty big deal if it's driven by China, because it was the big theme in Q1 was how weak China's economy was, and everyone's getting so hyped up about how weak it was that now this is quite aggressively reversing, and the demand is really evident in the oil market from China. Yet no one's really talking about it, and I think that could surprise people. I think if we keep an eye on that's an interesting one as well. But trade idea, what have we got? Who wants to take that?
Yeah, I had short, but actually wanted to go long. So yeah, trade idea this week.
You just decided, you just flipped.
I just flipped.
That's a good trader.
I just flipped. Like market makers got to flip all the time, right?
Yeah, you can't be emotional about it. Yeah.
So trade idea for this week, I wanted to go long in the 380 structure. So go long in the June-July 380. So this is based on a combination of fundamentals and financials. So of course, the contract has seen strong bullish momentum recently on the back of factors we mentioned earlier in the podcast. So strong bunkering demand. You have seasonal demand, especially with the heat waves in Southeast Asia. So that's demand needed for power generation, electricity. As well as that, you also got perhaps stronger Chinese demand coming into part of the macro story. And in addition to that, from the counterparty type data, we've been seeing like trade houses continue to build length in the June-July spread. You've seen fund buying, refiner buying as well, majors, a whole variety of players.
And what about the long to short ratio? We say refiners buying, a lot of people buying essentially. And is that people buying new length, or is it stopping out? Or is it both? Or
it's more people buying new length.
Okay.
Looking at the dashboards, long to short ratio. So in June specifically 50-50, but in July more selling, so 37-63. So it does seem that people want to be getting long in the front, especially in May as well. That's 60 to 40 long shorts in the 380.
But if you go back to so if you couple that with the graph, I mean, to me, if you're seeing increasingly in the last 7 days, basically, it looks like people probably were selling into that rally and now they're kind of stopping out, and it's kind of a bit of a bullish momentum going with that, right? So it's just whether or not how far that can go. I mean, does that look like a stop out to you? Are you seeing it in the data? It still looks like with the retracements that people are fighting it. So yeah, you could get a pretty decent melt up, but you're already quite strong on the spread. So what are you thinking for this? So kind of pricing thing, hold it into pricing.
I think it would be worth holding it into pricing, although it does mean that as soon as you see higher volatility, as well as more resistance and any signs that price action will be coming down, then that's a very good time to exit. So we're trying to catch the momentum, but at the same time, it could also be.
But if you're trading May and
contrarian.
people are buying so aggressively into the end of April, so as May is about to price, you know, May physical or June physical to price May is about to, it's clearly strong. I mean, trade houses, refiners wouldn't be buying it unless they knew that the physical that's going to settle that contract is hard to buy. So I think you definitely expect the momentum to carry through. And if you add stopping out on top of that, people rushing to exit before pricing today, probably, because given it's tomorrow, right?
Yep.
I think that, it's maybe a bit late to enter that trade, but nevertheless, interesting. You traded against yourself a little bit, and then you got long.
But I think it would still be dangerous to short at these levels, right?
From what you're saying and from the data and from being so close to pricing, yeah, absolutely. You've always got to be careful with the time spread, right? So if the time spread is having this rally, you can't blame, a crack, for example, can be very Brent related. There's a lot that can be going on with a crack, but a time spread is very explicitly linked to the physical differential once it's in pricing. So if people were pricing it there, they think it's there if it's this close to physical pricing. So I wouldn't kind of contrarian trade that so close to pricing. So yeah. Okay, so last week we asked, what level will OPEC bring supply, given it looked like, we were heading past 90 and potentially heading towards 100. And it looked like of the 166 people who voted, 43% thought between 95 and 100. But, a reasonable amount thought above 100, 110. I mean, someone wrote, what about your view? And I think we did kind of say it last week, but I think for me, it's almost like a trick question because they didn't do it when we went super high in 2022. So why would they do it now when you're starting to get a good hold on finally getting people serious about expecting oil prices to be higher? So I think it is over 110 that they start considering it. If they ever do, you just don't know. I mean, they might rather do it through products or who knows. I think it's probably going to be an evolution of the strategy going forward. But that's super interesting. I think it's been a lot of dynamics at play. And I think more and more to come. So tune in next week. We'll be here to do the same. And make sure to check out James's new Macro Mondays. Did his second episode yesterday, and he'll be continuing with that. Had some good feedback. So please have a listen to that. And see you soon. Thank you.